Hi, welcome to this video. Let's continue to deep dive into the candlesticks. If you guys don't know me, my name is Austin, and in this channel we talk about investment and personal finance and lifestyle. We are doing a series on the fundamentals of the stock market, and right now I am talking about some of the important technical analysis aspect. Today we're going to continue the conversation and talk about the candlesticks in more detail. So first of all, let's talk a little bit about the general patterns and the time interval that maybe for investors they will be looking at, right? So over here, as you can see, I'm looking at the S&P 500, and this is on TradingView. If you guys don't know, TradingView is a very popular platform. It has a lot of great tools where you can do technical analysis on. So feel free to play around. It is free to use. So each candlesticks represent a time interval, right? And what I mean by that is depending on what your time interval is, let's say if I put it at a day, each candlestick means 1 day has passed, right? So over here, I am going to be looking at, let's say this is a October 14th, 2021, right? And this is the opening price for October 14th, and this is the closing price, right? So today we're going to talk about the different types of these candlesticks and how they form patterns that can provide additional information for you to time your price entries. This will be a relatively long video, so I will be dividing it into sections. And without further ado, let's get started. First of all, let's talk about the most popular candlestick pattern, which is called a doji. So what is a doji? It's essentially when the opening and the closing price of the stock market for this time interval is almost the same. So let's say if we're looking at a daily basis, for this day, it looks like it's going to be closing at almost the same price at the opening price, right? If you guys don't know what I'm talking about for closing price and opening price and high and the low, please refer to the prior video, which I talk about the fundamentals of the candlesticks. So in this case, you can see, right, the high and the low are actually quite significant. There are long wicks. Wicks basically means the same thing as high and low, versus the body is talking about the difference between the opening price and the closing price. So the horizontal lines over here, this like green blob in the middle, this is the body, versus the wicks are basically the whiskers over here, right, of this candle. In this time period, what we can tell is that there is at a certain point a lot of buyers in the market, and the buyers actually wins over the seller. So there's more demand, which pushes the price all the way up. However, at a different time period of the same exact day, there were a lot of sellers too. There's more sellers than the buyers, and they push the price down. However, at the end of the day, there was almost an equal distribution of buyers and sellers, causing the closing price to be almost the same as the opening price. Hence, the body is very small. So for a doji, what you want to see is a very small opening and closing price difference, and you want to see some wicks from the high and the low. So this really just means that there is an indecision in the market for this time period. There was a lot of sellers, there was also a lot of buyers, but we don't really know where the price is going to go, right? So you may ask, like, how is this helpful, right? Well, doji by themselves doesn't really mean too much. However, it is very commonly used with other patterns for analysis, and they are quite good for some kind of price entry prediction. So let's talk about the one of the doji patterns that's formed with other candlesticks. The first one is called a morning star doji. Morning star, you can imagine, is like it's the morning, right? So the sun just set, and now it's going to be rising back up. So the price looks like it's going to be rising back up. This is what the morning star is showing. On the prior days, the price was dropping, which is shown with these really big bearish candles, these red candles. However, at one point, one of the days, the candle is formed as a doji, there is an indecision because there's a lot of buyers at a certain point, a lot of sellers at a certain point. However, the closing and the opening price is almost exactly the same. And then the next day occurs and there is a huge bullish candle, which is shown by this green candle over here. So a Morningstar Doji usually signifies a bullish reversal. It doesn't guarantee it, but it signals a potential, right? It means that the price might be trending up, and this could be a potential good point, maybe for people to purchase the stocks for this company. So what you want to see for a Morningstar Doji is that the body of the doji does not touch the body of the previous candle or the next candle beside it, right? Like over here, this body, even though it touched the wick, but it never touched the body, right? There's a gap. It's not necessary, but this is usually what you want to see. This again signifies a potential bullish reversal. And the next one that we're going to talk about is a evening star doji, which is pretty much the opposite. It was rising before and now it's about to fall, right? So instead of first seeing bearish red candles, we're seeing bullish green candles accompanied by a doji with a body that does not touch, and then followed by a bearish red candle signifying the price is going to start to drop. So again, this means that at a certain point there was a indecision in the market. Maybe the price has been driven up so high, all of a sudden the buyers are not so sure it's a great time to continue to buy, and the seller decides that now it's time to go in and let's sell. And in this case, then this could signify a potential bearish reversal. Again, these two patterns between the Morningstar and the Evening Star dojis are two of the most important patterns, right? It alone does not form a strategy. You should not buy at every single Morningstar doji and sell at every single Evening Star. It does not work like that. However, if you're an investor and you're looking to buy a stock because you believe in the company, you look at the revenue, you look at the asset of the company, and you see what is the price of the stock, and you think that it is a decent time to buy, but you just don't know what's the best time, right? Then you can look for a Morningstar Doji. Like right now, we're in a bearish market. So in this case, you may want to look at, hey, on a weekly time frame or even maybe daily time frame, if there is a signal for a potential reversal, and maybe you want to start accumulating during these times. All right, let's continue to talk about a few more patterns. The first one that we're going to continue to talk about is Gravestone. As you can see in the Gravestone, the opening price and the closing price are almost exactly the same, and there is a huge amount of buyers at a certain point. However, the buyers actually got pushed back down because they did not win, they did not close at the higher price. However, they closed about the same price. So the sellers actually came in near the end and pushed the price back down. This signifies a bearish signal because the sellers came at last and they were able to push the price down. We'll go through some examples in the future which will help understand these patterns as well. The next is Dragonfly, which is the opposite of a Gravestone, where there were a lot of sellers at a certain point, but at the end of the day, the buyer actually came in and they were able to drive the price back up all the way to be the same at the opening price. This is a bullish candlestick. We're then going to talk about shooting stars and hammer. And this is where you'll realize, oh my God, there's so many different patterns, right? So I'll talk a little bit more, but essentially, shooting star is very similar to a gravestone, right? In this case, the difference is that a shooting star has a bigger body, but it still has a long wick at the top. So What this means is it tells almost the same picture as the gravestone. For the gravestone, there were a lot of buyers at a certain point, but it got pushed back down at the end to cause the closing price to be the exact same or almost exact same as the opening price. In a shooting star, it's the same story. There were a lot of buyers at one point, but at the end of the day, the sellers came in and they were able to push the price back down. And in this case, it's actually lower than the opening price. So you have a lower closing price than an opening price. And that's why it's telling the same pattern, which is a bearish signal in this case. Similarly, for hammer, this is very similar to Dragonfly, but in this case, the seller were winning at the beginning, but the buyers were able to push the price all the way back up to be even higher than the price than the previous or than the current opening price. I mentioned that you can see similarities between the hammer and the dragonfly, as well as the gravestone and the shooting star. And there's a lot of names in here. We only talked about 6 patterns, and you can see that it gets a little bit confusing. I just want to say that the takeaway over here is you should be able to read these candlesticks without really remembering the name. You just need to understand what they really mean for this specific time frame. And does it mean that there's more buyers winning and there's more sellers? Which equates to supply and demand, right? When you have more buyers, you have more demand, then you don't really need to remember the names of these candlesticks. For example, I know for this hammer, again, it means initially there are more supply. That's why it was pushing the price down. There was more supply, there's more sellers. However, as the time went on, the buyers came in and there's more demand, and demand actually became higher than the supply in the end, and then price pushed the price all the way back up. Whether if it's a bullish or bearish signal is often shown with who was able to kind of win in the end. And because in this case, the buyer were able to push the price back up and to be higher than the seller, then this is a more bullish signal, right? In trading and investing, there are so many different techniques. And in candlesticks alone, I have seen that there are hundreds of candlesticks. I definitely do not know all 100 of them. So do you need to know every single pattern and memorize their names? Well, definitely no. Because if you look at the richest or the smartest traders, I don't think many of them know more than a handful of candlesticks. Sure, smart ones definitely would know a little bit more. However, most of them would just understand supply and demand, and you only need a few candlesticks to really understand that. And you want to stick with the information that works the best with you, that other people are also looking at, because you can then understand what their behavior are. You're not made of computers. If you have 100 different variables, you will not be able to plug all of them in and make a better decision. Instead, probably in that case, we'll make a worse decision because we won't be able to understand exactly what is the pattern that's going on over here. All right, well, this is just an introduction to the patterns, but we will go into some real data examples in subsequent videos. I hope you enjoyed the video, and if you do, please help out the channel and subscribe and like this video if you did. Thank you so much, and until next time.